It certainly has been one of, if not the most talked about stocks of the year. And today, GameStop will give its new crop of Robinhood investors a fresh look underneath the hood, so to speak, in its first results since becoming one of Wall Street's hottest and arguably most controversial stocks. But let's talk more now about this and where GameStop and what it may signal about the overall market. Joining us now is Babelfish Analytics founding partner Jeff Alexander. Jeff, I never would have imagined that little old GameStop, you know, the mall-based retailer where you go and buy video games, could have not only become so important, I guess, to itself, but so important to the overall stock market. What do you make of what's going on with GameStop?
Good morning. Thank you for having me on. And I absolutely agree. I don't even remember the last time I've been into GameStop, and my son's a gamer. So, you know, to me, it was just a little store that's out there in malls that, you know, we walked past when we were going to malls. But yes, it has become the most important stock in the stock market this year. And what it taught us, everybody's dissatisfied. Everybody's dissatisfied with the current market structure. Mutual funds, individual investors, regulators, politicians, and quite frankly, even market makers. And what this stems from, and the problem is that we're dealing with a regulatory structure that dates back many, many years, and it's just not well suited for the marketplace today. So last time I came on, we spoke about the effect on institutional investors. And what I told you was that the cost in retail-oriented names had increased by up to 3 times, in especially in names that were retail heavy. Now, I didn't talk about individual investors. I think it's really important to talk about individual investors. A lot of the frustration, a lot of the congressional hearings, what they're talking about is a lack of transparency. Am I getting the best price if I'm a retail investor? And we've got these regulatory reports that people look at. They're called 605 and 606 reports. They date back over 20 years. They don't apply anymore.
Yeah.
They're very hard to interpret, and that's a lot of the frustration. Nobody really knows what they're getting. So we decided.
Yeah, I know, and we've Jeff, let me jump in here. We've had hearings on GameStop, okay?
Yep.
Do you know, and we've learned, and I think we all are smart enough, especially if you're watching CNBC at 5:15 in the morning, you're smart enough to know this. No cost to you doesn't always mean something is, quote, free. We have learned that. Do you think that despite all the Sturm und Drang of the hearings, that anything around market structure is going to change, specifically around the idea of payment for order flow? Will that change?
I do not believe that a regulatory solution will come out of this. If a regulatory solution does come out of this, it will not come out for years. It will miss the mark, and it will have unintended consequences. What I do believe is that a commercial solution will come out and provide an alternative to payment for order flow, which will quantitatively prove that retail investors are able to get better execution quality than they're currently getting now. But a regulatory solution.
Let me ask you this, because Jeff, I want to jump in again. I apologize. We always talk about the Reddit trader, the retail trader, maybe buying 75 shares on Robinhood. I get that.
Yep.
Many of our viewers are going to be buying mutual funds. They're not buying individual equities. Those mutual funds also buy the equities on behalf of the fund. Okay, that's much more prevalent. Do you think that the average, Fidelity or Vanguard or what American Century, whatever the fund family is, do you think they're getting best price and best execution for their dollar?
Well, our research indicated that they absolutely are not, because what you were doing is you were taking, in some of these names, 40% of the trading volume out of the marketplace, and they can't interact with that. And if you can't compete for that if you can't compete for that 40%, you're dealing with a smaller pool. You're trying to buy the same amount, smaller pool. It's like anything else, supply and demand. And yes, they are getting much higher costs. Their returns are being harmed. That is without question.
Shepard Smith here. Thanks for watching CNBC on YouTube.